Hello, 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 hello. What's going on, everybody? Welcome to Now Stock Trades. All right, guys. Sorry about the late live here. Busy day. Also, just wanted to talk about a couple things that happened. Honestly, guys, lots of things happened this week. This month has been pretty well. Looks like the portfolio is recovering. Up 11%, $104,000 on the month. But earlier this week, we were actually up to about 1.1 million, up $240,000. 200, about 230,000. And ultimately, I feel like, given the stock we like to talk about, I think that we might be on some form of recovery. We had this weird little dip, and then all of a sudden we had this transition onwards into this ascending. And then if you look at it closely, you can see that we're just literally speeding across the edge on that lower channel for Clover. Now, when it comes to Oscar, we're going to go ahead and give our analysis and take on it. But what I find interesting is the CEO was doing some damage control recently, and he pretty much went ahead, and we're going to watch this video. And, he assigns his own price target in 2027, about $45 to $55. And what we're going to be doing in this video is we're going to analyze what he's saying, okay, and use our software, calculate the intrinsic value, and do, just straight up hardcore due diligence, look at the analyst estimates, institutional ownership, yada, yada, yada. And we're going to figure out is what he's saying correct? And then if so, let's go ahead and apply it to Clover. And the overall market, you could go ahead and learn the kind of the equations we use here. Obviously, you're not going to have access to all the data. For folks that are interested in having access to the data, we had a lot of people signing up. Congratulations to all of you. We are running this coupon code SAS. You just type in SAAS in the coupon code section. You get $1,200 off instantaneously for lifetime access, one-time payment. Access to all of our data, all of our stock picks, the options analysis platform we're going to be basically building out, and essentially how to make passive income, and how I'm going to be making anywhere between $200,000 to $800,000 per month. And I have made last year we were doing it hardcore, just to show kind of the, put the nail in the coffin there and show we're making around 30 to 60,000 a month. And we're just showcasing that on our lifetime access members, just to give a little taste. So we're going to go ahead and do all this. Just very quickly, a nice announcement I would like to just give out is, I'm very proud that we've announced our new real estate firm. This is the logo. It's a beautiful logo. It's housing and commercial real estate, and also like kind of stock bars as well, utilizing covered calls and cash secured puts. We're going to be investing $50 million in the next 15 years in Arizona. So that's amazing. $50 million in the next 15 years. And ultimately, it's going to be it's going to be an amazing ride. And very excited to be able to share that with you all. So without further ado, let's go ahead and talk about Oscar. So Oscar right now is up 6.64% on the year. 1 year's down 8.66%. If you don't recall, we actually talked about Oscar near the $2 region. You can watch my old videos. We talked about it since then. To the peak of Oscar, it was up 937% 10 bagger. Now it's up 555% from the all-time bottom. And the goal right now is like to say basically what's going on. So, I guess we can, let's start here. Before we talk about what's going on, it's important to talk about the overall sector performance. This is year to date, so it's pretty much starting January until ending until July. And it conglomerates all of the sectors of the S&P 500. There's basic materials, utilities, financial services, industrials, etc., technology, real estate, right? And the one that's underperforming in the past year to date is actually healthcare. Healthcare is underperforming. Now, is this a temporary underperform? Actually, it is really underperforming to a point where if you look at the 10-year, you see how the year to date is highlighted. If you look at the 10-year, actually healthcare is underperforming heavily, right? Healthcare and communication, but healthcare, everything at least is up in the past 10 years. But if you would have invested in healthcare 10 years ago, you would still be down. You'd be down 8.45% on average. That's a pretty abysmal return. And to just give you an example, to talk about why healthcare is hit, it has to do with medical costs, right? So let me just kind of basically give a couple stocks that people know. United Health Stick, right? I can't spell. United Healthcare stock. If you look at it in the past, year to date, It's actually down 44%. It lost pretty much almost half of its value if you actually go from here. If you go from peak to the trough, it lost about 53%. And you can obviously utilize our software, and you would have figured out that institutions were selling is you can do that. The problem is you need access to the data, and then obviously Wall Street, doesn't make it easy for folks. Now let me go here. How you doing? What's up, Diamond Hands? What's going on? Or Diamond Ape? 7:30 in the UK. We got people watching from all over the world. What's going on, Shant? Messiah Time. I appreciate you, man. I love you a lot, man. I love you all. Grobzy, I'm enjoying these late night lives videos. Yeah, I know. Sorry. I mean, it's just been kind of. I prefer doing them earlier, but again, I got to, you got to fit it when you can put it in, right? Just like how Californians drive. If they can fit it, they put it in. Freaking terrible drivers in California. Okay, so if you would have invested a year ago, you'd be down 50% for this. If you would have invested 5 years ago, you'd be down 6.56%. So it's very clear that healthcare is not doing well. Now that's just one stock. You can argue and say, "Hey, Al, what about other stocks?" That's fine. That's fair. Year to date, Humana is down 5.81%. Year basis, Humana is actually down 39%. 5 years, it's down 39%. So you could see there. Here's another one that was actually trashed this week. Molina Health. Molina Health is down actually 42% this year. On a year basis, down 50%. But really, the past 5 days or like past month is literally been going on a rampage. It literally just basically dropped here. I mean, it was dropping around 12%. Then all of a sudden here, it just basically hit the floor. So you can see ultimately kind of where this is at, and you can see this drop. This is a huge, huge disruption drop. There's a huge recycling happening in healthcare, and Wall Street right now is basically exiting its money, trying to figure out, any bit of breathing room to see what are alternatives, to a point where a lot of folks were saying that Alignment Healthcare was doing really well this year. It was. I mean, at one point, Alignment Healthcare was up 71% year to date, but now look at it. It's only up 1.73%, right? So you can see it fell back down to $11.76, right? And then if you look at it from the year, right? So if you look at it from the year, 31%. Now, let's look at Clover. Clover year to date, it's down 3%, but on the year, it's actually up 75%. So actually, you're not going to believe this, but Clover is the only healthcare stock out of all of them that I've seen that is outperforming, right? And we're going to go ahead and, from the first principles perspective, show you this. But let's keep going. Centene stock, it's down 61%, right? Centene, 6 for Centene. I don't know, right? Sounds the same, right? No, not really. But you can see all the way from the peak though here, all the way down, we're down 64%. It's actually a lot worse. Now the CEO tried to talk and try to basically reassure investors with a little bit of 6% peak here. She was talking and she was trying to reassure them. But overall, you could see the market is just, if you would have invested 5 years ago, you'll be down 57%. So the market's just going on a rampage, and it's really hurting healthcare. So when I show you this data, and I'm telling you in the past 10 years, healthcare is down, and then this is, year to date, it's down. You can see when I'm giving you the mechanics of what's basically constructing this, you can see, Fix is one of our stocks that we called out. It's one of our portfolio hedging modeling systems. It's done really well. We called it out. I don't know. I think we called it out during here. Yeah, we called it out somewhere. I have to check. Again, guys, we call out so many companies. We also called out, Robinhood at $9, and look where Robinhood is now. We called Robinhood when it was around $9, right around here, and then you could see it's a 10 bagger here, right? So we called Fix at 200. Thank you, man. I forget, man. Because it's just like I wake up, go to the hospital, try to take care of business, nonprofits, and then go here, make videos, and you forget what you say. But the beautiful part is everything's done first principles. So when I look at it, I understand. Oh, okay, this is why I did it, because I have a very rigid manner of how I do things. Okay, so going back to healthcare, let's see here. What else? Remind me. CVS is good. CVS stock. CVS is actually doing pretty good this year, 37%. Year is down this, so CVS is actually doing pretty good. We'll see what happens with the earnings. What else? Come on, what else? ELV. Yeah, that's another one. Let's do ELV. That's another healthcare stock. Year to date down 20%, year down 45%. Same thing, right? Just look at this. Look at this huge drop, right? So there it is, guys. So now let's go ahead from first principles perspective. Let's just go ahead and utilize the terminal. Again, you get access to all this as well. You get access for folks that are interested in a lifetime access to our software. Not only do you get access to the course content to basically be able to teach you how this is done, access to essentially how options is ultimately performed from an educational perspective, access to over 2.5 billion outputs of institutionally graded data, access to all of our premium stock terminal intrinsic value calculations, all this amazing stuff that normally would cost hundreds of thousands of dollars over the, like you normally cost $25,000-$30,000 a year, you'd get for a one-time payment, and it's very affordable and cheap. And you get access to the community that has a net worth of over $45 million. I mean, I would say if I found, I wish if someone can, for all the people that have joined, if you have other things out there that you found, obviously you guys are bargain finders, you guys are smart. If you have found other folks out there, like just doesn't have to be stock market related, other things out there that are just deals, because you guys know how to find deals. Can you like share them with me? Because I'm looking for some deals too, guys. Right? It's very hard to find deals like this. All right. So here's correlation. Let's go ahead and put Clover. Let's go ahead and put United Healthcare. Let's put Molina. Let's go ahead and put Alignment Healthcare. And I think we could do one more. What's a good stock? Let's do Centene. So this is going to compare the overall performance of all of them, right? And by doing that, we're going to have a very good first principled graph, and then we can see from this perspective kind of where we're going to be talking about it. We're slowly massaging it. We're mentioning it, and then now we're slowly massaging it. Then we're going to go ahead and talk about Oscar, what happened and their guidance and what changed. But right now, it's interesting. This is one moment. I think it's probably getting updated right now. That's probably what it is. Let's see. Let's look at these two. Perhaps this might. There it is. Excellent. Excellent. So, yeah, that's interesting. So I think this one, let's try a different channel. I think this one's, there's something wrong. Right. And I'm doing it late at night. So usually at nighttime, we like to do updates. So it makes sense. Kind of from the update perspective, kind of why I think it's just sleeping. So let me just go ahead and just open up a new tab here, and let me just do some, see if I can overwrite it here. Okay. So we said Alignment Healthcare, Clove. What else did we say? We said Molina. We said Centene. And then what do we say? United. Let's do United. So we'll do all that and then let that work. Let that think. All right, there it is. We went ahead and overrided it. Okay, good. Yeah, it's doing some updates, so tomorrow should be good. In fact, let me just double check something here. Let me just see something here real quick. I don't know. Oh, no, that's too complicated. Let's do something here. Let's do something basic. I don't know. Let's do Apple. 30 minutes. That's enough. It's extended. I'll just do all these candle. Man, I was gonna do a basic one, but this is a little bit complicated. All right. Yeah, so I think the correlation just needs some help. All right, so now we went ahead and we compared Alignment Healthcare, Clover, Centene, Molina, and United Healthcare. And what do you see? Clover Health is in blue. I wish it was in green, but it's fine. Clover Health is in blue. Oh, we should have done Oscar too, but it's fine. Oscar, yeah, we're gonna do Oscar right now. We'll eliminate. We should eliminate United and just, yeah, we'll figure it out. We'll see what we can eliminate right now. So you could see Clover is number 1. Alignment's number 2. Centene is like the pink, which you can see it's down here. Molina is in red, and United's down here. So we'll just remove Molina, and we could just, from a first principles perspective, just go ahead and override that and just work on. So we will do Alignment Healthcare, Clover, Oscar, and we will remove Molina. We'll do Centene and we'll do United. Just to kind of give an example, we'll put Oscar in there too. So just to get a little bit of perspective here on what's going on here. It's just nice. So you could see, am I tripping here? Hold on. There it is, Oscar. I thought I put it in. All right, so again, Clover is number 1. Alignment's number 2. Oscar's number 3. So you could see how these newer companies, you have Clover, Alignment, and Oscar. Okay. Then you have these incumbents, Centene, United Healthcare. You can add Humana here. You can add Molina here. You can add Evalescence here, right? So you can see from a first principles perspective, you can see how you can have the collection of haves and have-nots. Now, don't let Wall Street confuse you and say, well, hey, they don't care about Clover. No, man, don't be stupid, okay? Be data-driven. You go in and you type in Clove, and then you look at institutional ownership, and you can see institutional investor holdings is literally going up, okay? It's increasing. You do the same thing for Oscar. Again, this is all part of our stock terminal you can get lifetime access to. You go ahead and you see that, and you can see institutional ownership for Oscar. Look at that. It's literally going to the moon, okay? So don't be stupid, okay? Like, use data, right? Don't use like feelings. We don't do feelings. Use data. And we can analyze this, but it's just I like the graphs. But you could see there's the haves and have-nots. In Wall Street, honestly, you could go ahead and really you could do a great short. Would be short incumbents, go long new innovative healthcare companies. And what you can basically see now, what Wall Street's doing is Wall Street's pulling out their money. And that's why healthcare is underperforming. They pulled out their money right now from healthcare. And now what they're doing is they're trying to see what are going to be the batch of winners and losers. And what there's going to do in the next 5 years, there's going to be a total mismatch price direction. Think of it like, for example, Intel to AMD, right? Obviously, Intel's been doing, it's done pretty good recently, but now I actually, never mind. It's actually gone down. But if you don't recall from Intel used to be kind of a behemoth, right? And then 2019, it just kind of dropped. All this money dropped out of Intel. Where did it go into? Right? It went into AMD, right? Because AMD used to be like a $2 stock, and you could see Intel dropped, and what happened to AMD? AMD soared, right? So that's what's, again, from my experience, that's what I'm seeing right now, is you're seeing all these incumbents basically sell. And then now you're seeing all these newer folks that use tech, they don't use fax machines. They're pretty much, you could see this early precursor. And unfortunately, not a lot of people, again, you get access to all this lifetime access. And it's unfortunate. A lot of people have like access to this. They don't have access to a group of community that is data driven. Okay. So now that we talked about the healthcare market, why it's down, we talked about kind of what we're seeing here. Big thing really quickly, we're going to then talk about Oscar's financials right now. Let's see what's going on Monday. Anything important for us here for the topics of this video? We have United Healthcare Tuesday in the morning. We have SoFi. It's another one we talk about. Marathon. That's another one. But obviously PayPal and all this will give you a good spot on the economy, but obviously it's doing pretty good. This will be a good spot on the economy to see how people are spending. Caesars Entertainment to see what's going on. Penumbra is a company that I actually, it's funny because I actually, we use this product. It's a $9 billion business. It's done, it could be undervalued. I don't know. I have to look at it, but there's other competitors. Okay. So we have United Healthcare here. We have Humana here, but let me just go double check to see. So, these things here are big. Now it depends. We'll see kind of what's going on. If they mention anything about it, like a SaaS, there's a lot of it in subdomain leak for, someone did some amazing research and they found that there's Counterpart subdomain, which is a subsidiary of Clover Health. It's showing Humana there. That's going to be interesting. And then you have Cigna reporting. So a lot of the CVS obviously here, and You got the big, big 70 Max 7 here. I think Amazon here. Visa is a good proxy to figure out kind of what's going on in the economy. Caterpillar I like to use too. It's good at predicting recessions. Carvana is going to be an interesting one. Robinhood, we called the stock out at $9. Meta, we called the stock out when it was like, I said it's going to go to $500, $600, and it was like around $100. And everyone's looking at me like it's crazy. But hey, data-driven investing works. Exxon, no, this is Chevron. ExxonMobil, we called out as an opposite trade of value, and this performed really well in 2022 and 2023. Dominion Energy, I think Warren Buffett's, I don't know, might still hold this one. So lots of things going on here. Just good little brief through. But the ones for this video, United Healthcare Group, Humana, Cigna, really, and then CVS probably by proxy. So that's kind of where we're at right now. That's what I'm going to be looking at. Okay, now for Oscar, real quickly, is they had a previous revised forecast. So previous was 250 million operating income. So that was approximately about on average. If you divide that by 4, I keep pressing. Okay, so that's about 62 million on average about per quarter. Now they updated. They went from 250 million of income positive to 250 million income negative. So that's a $500 million shift, right? Because remember, 250 down, so that's zero. This is worse than zero. This is negative 250 million. So this is negative. This is pretty much losing about $500 million on average, right? So Q2 preliminary results, they released this so the market doesn't punish them, which is why, if you don't recall, a lot of folks were talking about Oscar online, about $21 for Oscar. And then it basically fell down 32%. A lot of people were talking about Oscar because, a lot of these retail investors, it's like a bandwagon, right? They're not first principled. A lot of people that have like over 100,000 followers, and obviously they probably don't even own the stock, but they like to jump on the bandwagon and they just talk just to get, I guess, engagement and attention. But unfortunately, a lot of these people, they see this and they start shifting in and buying. And you can see how stupid people are. They just kind of come in. And obviously, I do believe this is undervalued. We've been talking about it since $2. But the point is, as you can see, those folks back when it was around $2, $3, they weren't talking about it, right, on Twitter. And the same calculation is going to happen with Clover and a lot of these other investments that we have. They're going to end up basically like, for example, RGTI, we were talking about that as an opportunity play when it was in the pennies, right? When it was in the pennies, and essentially look at it now, high $21. Now everyone's talking about quant stocks. Again, you want to be able to get in, you want to see opportunity before the market sees itself, and that's fine. But again, a lot of these people, when they generate hype, it's ultimately going to end up falling into the stock that we own, which is good because then they buy these like weirdly weird call options. They start like gambling. And they're just going to give us their money because, options is a zero-sum game. There's going to be winners and losers. And majority of the time, people that sell covered calls and cash secured puts, they're usually on the winning end. Because I think the other way is gambling. Now, of course, you could do intrinsic value and really, have an edge on that and do long outdated calls, but you're still risking it. So quarterly preliminary results, opening loss, 230 million. The analysts expected about $55 million in profit. Missed forecast was 285 million. Medical cost ratio was 80 to 81. Now new range is 86 to 87. That's why you see this huge $500 million shift downward from 250 million of operating income positivity to negative 250 million of operating loss. So you can see it's because of huge higher normal than expenses. It's funny because if you look at the Bloomberg terminals and the analyst estimates, they haven't updated this. They're still showing about $7-8 billion, I believe, or whatever they had them at. And then they're saying 11 to 12 billion, which we'll talk about. They're going to be repricing the 2026 ACA market. A lot of people were basically talking about Clover, how, they're telling Andrew, who's been in the game for over 10 years, and then, Vivek has been in the game for over 20 years, how to run a company. It's like, okay, fine, then go start your own company. Like these people think like they know what they're talking about. They told them to get into Medicare. Medicare is not something you want to get into right now. Industry, a lot of these people, United, Evolent, Centene, Molina, they all reduced their profits, right? And obviously Molina's on the subdomain also for Clover Health, which is kind of interesting. Okay, so we talked about that. Crazy week, man. We got people putting in their life savings in this, meme stock. Uh, we're gonna watch this video right now. We're gonna do the first principles calculation. Again, my videos are long, but at the end of the day, this is like data driven, right? We're trying to break things down. We're trying to teach you, because I can go ahead and say this guy said this guy said this guy said this, but we're trying to basically teach how this is done. And this is kind of the method we're taking, because we're an educational platform, right? Very quickly, Palantir now is the world's 20th most valuable company. Again, here's us doing what we do. Here's 2023 in January. We were talking about Palantir. This is the setup. This is how I look like. People don't know who I look like. I have the camera off right now, and you can see it's up 2,100%, literally 21 bagger, right? You could see, yet we did it again, right? Why are we doing it? How are we doing this? How are the people that banged the drums of Benjamin Graham and David Dodd? If you don't know what that is, it's the disciples of Warren Buffett. How are these people, Manish Prabhai, Bill Ackman, Howard Marks, and now you have this guy who went from homelessness to becoming a multimillionaire? How are we doing this, right? It's clearly not luck, right? There's clearly something that is in this code. It's in this calculation that hedge funds have that we are doing correctly to making money. And ultimately, it goes back to basically you. Do you want to get access to this and be able to break out of the matrix, to live a life that you deserve, to be able to go to a restaurant and not being able, being able to afford anything and not having to look at the freaking price of something, being able to understand that when you go buy something, you will always have money in the bank account, right? To be financially free, being able to take a 2-3 month vacation, not having a boss breathing down your neck. In fact, the boss is afraid of you because he knows you have options. Okay. Right. So ultimately, this is the power of what I'm trying to teach you. It's really about financial independence. You know what I mean? That's really what it's all about, honestly. So with that said, we talked about all these things. We talked about the $50 million we're going to be investing in Arizona in the next 15 years. Mentions have gone down for open. We'll make another video about that. That's one of the meme stocks. Crazy stuff happened this week, but it's on a downtrend. I have access to this because I pay Twitter X $1,000 a month. I pay them a lot of money, thousands of dollars, and I get access to cool futures that I'm able to search through their API systems. Okay, and then what else is here? And then we have Tom Lee coming into the AI summit. A lot of folks now are going to be basically talking about AI in healthcare. First, it was the AI chip infrastructure with NVIDIA with the GPUs. Then it was the shovel like Palantir. And now it's going to be the end user end products which are AI products like Open Evidence and potentially Counterpart and Clover Health, et cetera, et cetera. Quickly, let's go ahead and talk about Oscar's short before we go into that video. This is the short analysis for Oscar. In the past 3 months, we have shorts increasing by Oscar 322%. Again, a lot of Wall Street folks are shorting healthcare stocks heavily. What I find interesting, and this is actually going to be pretty educational, is I want you from a first principles perspective, look at the short interest float. Oscar's 35%, and yet it's up, from 8.46% from 3 months ago, up 322%. So why is the share float for Oscar 35.73% short with a high potential of a short squeeze? Why is healthcare, and again, you can see they're very confident, especially with this Q2 preliminary guidance that they put out. Why is Oscar's short interest so high? And yet people basically, they look at Clover like a crap stock. But if you look at Clover's short interest, remember, Oscar was 35%. Look at Clover. Clover's short interest is only 9.98%. Why? It goes back to what I showed you regarding the graphs, right? In terms of what's outperforming and what's not, right? That's the reason why Clover's doing well, right? Because Wall Street's smart. They understand that this thing's about to be profitable, which is why Clover's short interest is not that high, right? But if you look at it, from an 18-month perspective, it used to be high. Back when we can't go back anymore. That's fine. But when it was a short squeeze, it was a lot higher, right? So now obviously there's fundamentals tracking. So now let's go ahead and look at Humana, right? Let's go ahead and see Humana and see what's going on with that. So Humana now is 3.57%, right? It used to be, I'm sure, the shorts had their ball day. It used to be around, for a stock like that, 4%, something, safe like that. Then you have United Healthcare, 3.57%, right? Then you have, let's say, Alignment Healthcare. Oops, sorry, I put the wrong ticker. Alignment Healthcare. The short is 9.46%. Let's do 3 months. And you could see, in fact, actually, I think what would be good is let's look at 12. Yes, let's do 12 months. So you can see the short for alignment has gone up 99%. But you can see it's 9.46%, just like, around Clover's short value. For 12 months, Clover 8 to 9. Again, you see how alignment it got more shorter than Clover, right? In terms of the rate increase. Let's look at Centene. Centene's another one that got hit hard. Centene, 2.92%. A lot of these stocks, guys, a lot of these stocks, Wall Street wasn't anticipating this. So a lot of these darlings, these incumbent darlings, Wall Street, wasn't only a few people were actively shorting, or you could see, historics. But when you go to Oscar, given that there's a lot of retail frenzy around it, you could see the short interest is 35%. Okay. But if you look at Clover, you could start to see the institutions are starting to accumulate this. You could see now, and the shorts are actually starting to go down. It was actually 12. So if you look at the past, let's say 2 months, we were up, but then now shorts are starting to cover. The past 7 days, look what happened to the shorts. What are the shorts doing for Clover? They're covering now. Why are they covering? Right? They're not dumb. Okay. Why are the shorts covering for Clover? Because what's going to happen in Q2, right? Again, you have to go back to the data. Okay. Let's go ahead and look up Clover real quick so we can, again, this is educational, right? So look at Clover, look at net income. Q1 2024, they were down negative 19 million. Look at Q1 2025. They went from negative 19 to negative 1.27 million. They improved by 18 million, guys. They're about to be break even, but let's be smarter. Let's look at Q2. Q2 last year, 2024 Q2, they were profitable. They actually were profitable, 7.41 million. So if they can improve by 18 million, what do you think they're going to do now for 7.41 million? How much do you think they're going to improve by? What do you think what do you think it's going to be? Who knows? Maybe anywhere between 10 to 37 million. I calculated around 35 million or something. So I would say anywhere between 10 to 35 million. Who knows? Right? So you could see, why the market is looking at this, because even with the gross margins of 23.57%, they still were able to improve. And this has really, really good margins. So I bet you it's going to improve even more. What that basically means is the newer members that they tacked on are not killing them financially. And who knows, maybe Q2, maybe expenses increased. I don't know. Right. But I think they're effectively managing their cohorts. So you could see right now, the short interest for Clover is going down now. It actually dropped from 12.4 to negative 19.52 because I was bringing attention to it. I was like, wait a minute, this thing's becoming a potential short squeeze candidate because the utilization was high and all this other stuff. But then now they're starting to basically drop. It was ascending, but now they're coming back. They're realizing that, holy crap, man, these people are smart and this thing's about to be profitable. Now, again, let's go ahead. We can just kind of remove all this junk and focus in on this, and we could just kind of ignore this and listen. So you could see when short interest drops like this, especially when it's backed by fundamentals, this is when they turn free cash flow positive and they had that Q2 profitable quarter. You can see the shorts basically dial down and then the stock price goes up. You can see it now. Shorts are starting to dial down again, and we may be setting ourselves up for another run up, right? And you can clearly see this from both a fundamental analysis perspective, from a short analysis perspective, but also clearly if you go ahead and just from a technical analysis perspective, you could go ahead and just kind of zoom in on here. It's hard to see. We can just, maybe we could do quarterly. Yeah, it's hard to see here, but you could see you have a cup and handle it style effect. I think it's more easier to see on the monthly, but you could see how you have a cup here, a cup and handle, right? And again, it's like reading tea leaves sometimes. You got to go ahead and go here. Cup and handle technical analysis. This is kind of what it is. And you can see we're starting to basically formulate this potential breakout, right? So that's kind of what they're seeing. And then it tracks fundamentally, right? And this is not including SaaS, okay? So you can see that's kind of where we're at right now. Okay, so we talked about this. We talked about the analysis here, the numbers. We talked about this. I'm just going to remove this. Now we're going to talk about this guy. Let me just make sure. We talked about Palantir, how we called that out. We talked about the $50 million investment in the next 10 years in Arizona. We talked about Tom Lee visiting All On Podcast for the AI Summit, and obviously Clover's AI. So now we're going to go ahead and watch this video, and we're just going to stop the sharing of the screen, and we're going to go in and share the audio version of it. Okay, and we're just going to go ahead and just play and pause and then talk, okay? Then we're going to go ahead and do the calculation.
In 2025, our objective is to have, so we made money in 24.
Okay, so he said we made money in 24. So let's show this. So again, let's go back to the data and let's type in Oscar. So Oscar, indeed, if you go to 2020, if you go to net income, let's zoom in. They made about $275 million in, in 2024, they made $25 million in total. If you count Q1, Q2, Q3, and Q4, they made $25 million. Okay. So yes, they were profitable on a GAAP basis of net income. Back here, this is why we started talking about it. They started becoming EBITDA and it was tracking. And that's when we were starting to do we're looking at free cash flow and we were tracking the free cash flow. And that's why we were confident. And, when it was $2, $3 saying, hey, this thing's going to go and it's going to blow. We were confident in that, primarily, honestly, because of what he's about to say right now. So we're just going to go ahead and share this tab again. And we're just going to go ahead and play it.
For the first time. We made adjusted EBITDA in 23, which is what we told the street. But
so adjusted EBITDA was in 2023, and that's like funny money, but it's basically on track, right?
24, we actually made EBIT. We made real money you can count, right? Instead of funny money. And so that kicked it off. This next year, we've promised 2.5% margins to the street in our earnings through the year, and growth of up to 11 billion in premium. And why those two numbers matter?
Now they're saying growth in 11 billion in premium. I find this interesting because, again, data driven. If you go to Oscar here and you look up our data, and if you load the chart, obviously here are the analyst price targets. For people to analyst price targets have been revised downward, so be careful. This will be updating soon. But now if you look at what you would call it here, it'll be updating. What do I want to do? Yeah, let's look at analyst estimates. He said 11 billion, but look here. Here's so you could see. Actually, you know what? Wall Street is right. Wall Street actually did this correctly. So you could see from Oscar, you could see how they're tracking, 12, 11, 12 billion. So this is actually good. Wall Street's doing this correctly. Now for net income, now they're tracking them to be negative, because before you see how quickly the terminal updates. This is negative 61. That's actually wrong. It's actually going to be negative 250 from what I'm understanding, but I think it's going to end up being negative. Well, it's going to be negative net income this year, that's for sure, right? And then 2026, and then here's 2027. So they're expecting huge profitability in 2027. That's kind of you could see that there in earnings per share potentially anywhere between $1 to $2 in 2027. So actually, it's tracking out. So now let's go ahead and go. I'm sorry, I didn't show you this. So let me share the tab. What I was going to show you, here's the analyst price targets that I was showing you, but I went here and I went to institutional ownership. No. I went to analyst estimates. Sorry, it's late at night, guys. And here it is right here. So I was showing you the projected $11-12 billion he was talking about, and ultimately the net income where it could go in the future, with EPS estimations going all the way out to 2027. If you go to other places, they're not going to give you that much, right? We give you all of it, right? What's on the Bloomberg terminal, right? We have access, right, to all this information, right? And we democratize it, one-time payment, right? Lifetime access. So now let's go ahead, guys, and let's just go back to what he was saying here.
Is that 11 billion at 2.5% margins in the insurance industry generates a $5.5 billion market cap. We're at 4 point something right now, 4 point low, right? So that's one piece. At 5% margins, you get a 1x of revenue. And so by 27, what we committed to the street is we're going to have 5% margins, real margins, not EBITDA, EBIT, and we're going to have 14 billion in revenue. That makes the stock price of the company somewhere between $45 and $55 a share. depending on the PE multiple from where we are today.
So he's pretty much basically talking about the PE multiple of where we are today. Okay. And you can, the PE multiple on the top of my head, last time I checked, it was around, based off of today's prices, I want to say it's 36, around 36 PE multiple, right? So let me go ahead and stop the sharing of the screen here. We're going to do some math right now. We're going to do some good old math here. Now, interesting. Let's go to Oscar's intrinsic value right here. Let me get the share outstanding. This is the most accurate share outstanding, 254 million. So 254 million. And Wall Street is thinking EPS, let's say, where's the EPS average? EPS average 1.4. So let's do the high. 2.1. So what is that? 2.1. But let's before we do that, let's actually calculate our own EPS. Let's just do the 574. So they got about 574. So that's about 2.2 earnings per share in 2027 multiplied by, what did I say? Let me just look at it here. Yeah, so yeah, I was right. 36 multiplied by 36.12. That's about $81. So he's calculating that. So let's do the low now, which is 270 million. 270 million will give you 1.06 times 36.12. That's about $38. So based off of this, and I see where he's getting his price targets. He's doing, what he does is, I'm not going to show this. I'm just going to show something more sophisticated than this. This is too simple to show. You guys can easily calculate this. A child can calculate this. But essentially what you do is you take the overall projected net income and divide it by the outstanding shares. That'll give you earnings per share, right? Because you're dividing all that income onto the shares of shareholders, right? And you take that earnings per share, whether it be $1 to $2, and you multiply it by the current PE, right? The trading PE. And right now the PE is around 36. When it was around $20, the PE was around $45, $48. So based off of that, he did the PE calculation, and he said the stock price should trade anywhere between $45 to $55, right? Now, what we can do is let's just go ahead and do our own calculation. I messed up. I put the wrong ticker. So let me just, sorry. Let me just reload this. I put the wrong ticker. My apologies. Let's go ahead and just hit this and then type in Oscar. Again, this all comes with lifetime access. So now let's go ahead. Now we need the financial sheet. Where's the financial sheet? Here's the financial sheet. Here's the free cash flow. So we could go ahead, do the average. But let's say, given that 2024 was a good year, it's going to be repriced. Let's just do this for right now. The growth rate for Oscar, here's 9 billion. And that's about 2024. In 2027, he was saying 11 billion. So that's 11,000. Again, these numbers are in millions. That's about a 6% growth rate. Yeah. So based off of this 6%, well, let me just make sure the number's 6.22%. Let's just do this 6.22%. You go ahead and do this. And then you see this. Look at this. Look at the base value. What is the base value? You see the base value? $48. $48 base. You see how powerful that is? All I did, again, guys, this is not rocket science. Okay. I put in Oscar. I got in all this data. And then I went ahead, I took the average free cash flow, which is not average. It's the last one, 950. I should be a lot more conservative, which I'm going to do right now. This will explain to you kind of why Wall Street thinks the way it thinks, right? You see it, right? Starbucks minting knowledge. What did he say? Again, I'm just going to replay it because sometimes, I have short-term memory. So let me just kind of go ahead and explain. Let's just kind of explain what he says.
Not EBITDA, EBIT. And we're going to have 14 billion in revenue. That makes the stock price of the company somewhere between $45 and $55 a share, depending on the PE multiple.
So $45 to $55 a share, right? Let's go ahead and share the screen now normally. Let's go back to the intrinsic value. What do we get? We got a base value of $48. Okay. So you can see how this is important. You see how you can set your own price targets? Wall Street doesn't want you to know this. This is how I became a millionaire, right? This is how I went from homelessness to becoming a multimillionaire. Okay. We have a larger portfolio that I curated as over $15 million that I'm using for the wheel strategy to go ahead and drop $50 million in Arizona in the next 15 years to buy real estate. And here's my real estate company, right? So, again, we're definitely minting knowledge here. Okay. The whole point is to teach. And if you want access to all this data, you can run these analysis right now. And it's literally, I mean, this is the most cheapest thing you can find online. I'm actually confident to say this is probably the only thing you can buy that's actually going to make you money. Everybody, you buy things out there that's just going to steal your money, and you're just going to use it as an end user product, right? You go buy food, you're just going to end up shitting it out, right? This is the only thing you can buy that's going to make you more money, right? You can talk to lifetime access members, right? They can tell you. We have testimonials too for folks that don't know, right? So based off of this guy's 950 million, again, that's assuming that's so hard to do right now, guys, right? But then 6.22%, right? So now let's go ahead and do the classics view. This is the base case, right? Let's look at the best case. The best case is $64, right? So recession 22, right? Bear case 38, base case 48, best case 64. So this is the calculation he's doing. Like I said, my calculation is, and here's one of our lifetime access members, best investment in your life, right? I made this to where I put in my heart and soul into this. I put my freaking blood, sweat, and tears into this. Like, you're never going to see you're never going to see a product like this created that has just so much sophistication. And I put in hundreds. God, how many hours I put into this thing, right? I mean, right now it's 12:30 a.m. in the morning. I have, people out there drinking, having fun. I'm out here 12:30 grinding with you guys because we want to grind for a better future, right? It's 12:30 right now in Arizona in the morning. It's currently, 1, 2, 3, 3:30, and we have Clover to retirement right now, up at 3:30 right now, grinding his ass off, working night shifts, right? This man does not sleep for us, right? I'm working hard because I have a chip on my shoulder because I'm tired of the rich getting richer and the poor getting poor. And all it is that's differentiating them is data. It's not because the poor are stupid. No, man, these rich people are dumb as these rich people are stupid. You know how many rich folks I'm surrounded with? The only reason why they're successful is because their mommy and daddy pays for things. The reason why they're successful is because mom and dad through nepotistic behavior help them. That's who you're competing against. You understand me? Once you get access to the data, once you get access to all this information and all this data, you become unstoppable because these rich folks don't have your work ethic, right? A lot of it was handed down. You get the data, you apply your work ethic, you work your ass off, you're gonna destroy them because they need mental health days. And again, I'm not trying to attack mental health days, right? But if you want to, eat your meat, fuck mental health. Work your ass off, right? Then you can afford a psychiatrist or whatever the hell you want, right? So like F your emotions, right? F your feelings, F your emotions. Forget about, you getting, offended, right? Put your head down, get to work, and go build your legacy. So when you come back home, your wife looks at you like a man you are, okay? And if you're a woman, I don't know, try to extrapolate what I said onto your life, okay? I don't know, right? Right? We love women, okay? All right, so there it is, okay? And it's late right now, so I can't extrapolate for you because I'm a man, right? I don't know, right? So the whole point is to empower you guys. So as you can see, this is where it's at. But now I'm very hesitant to use this. Now let me go ahead and, conglomerate all of these things. So I think it's safe to say, I'm okay taking 6.22%. 6.22. I'm going to go ahead and first off, I'm going to take a screenshot so we don't lose this hard work. And I'm going to go ahead and I'm going to go here. And then I'm going to go back to the unclassics view. And then here's the base case of $48. Let's look up the advanced matrix. The advanced matrix is $34 to $69, right? And that's what he thinks is going to trade at in 2027. Right? Now let's go back to the classics view. And now this time, because we already took a screenshot here, I put in our hard work. Now I'm going to take the 6.22. But this I'm going to re-enter this, and now it's going to calculate a lower average free cash flow. By doing that, we get now 201 million. You see how we dropped from 950 million down to 201 million? Now let's go ahead and do the growth rate of 6.22%, because you have to put the growth rate, right? You do that. Now you get a recession case of $4.86, a bear case of $8.04, a best case of $10.16, and a best case of $13.65, right? And now we can go ahead, and now let's go ahead and move this here, okay? And now let's go to Oscar. Where the hell is Oscar? And you can see Oscar right now is $14, right? So it's trading near its best case. Now, it's around $13.65. So based off of this, if they go lower than the average free cash flow of $201 million, then you can expect that we might see Oscar anywhere between $4 to $13. It might actually go down lower, right? So this is why it's important. We do a long range intrinsic value calculation for Oscar. And the long range, yes, it does say, we took a screenshot here so we don't forget our old work. Yes, $22 to $64. Yes, if what the CEO says comes into fruition. That's why a lot of people will say, Andrew Toy needs to be splashy. Andrew Toy needs to say X, Y, and Z. Well, this guy basically said his stock is going to be $45. And what ended up happening to the stock price? Nothing. Still 14, right? Because again, guys, the market is data driven. Okay. The market sees this. And once a stock becomes financially responsible, which it means it's responsive to the intrinsic value calculation, it's when it starts knocking on the doors of free cash flow and net income positivity. Okay. So based on this, if Oscar doesn't maintain 201 free cash flow, then you can ultimately see Oscar lower. So there could be more of an opportunity. But let's just go, now that we understand kind of where we can see Oscar, and based off of the recession to best case, and now that you know that, if we go ahead and put the best case scenario, which is, they could grow a lot higher, which is 6.22%. They could grow more, but, based off of this, you could see a recession case is 22, bear case is 38. So this is going to be this 22 is the very extra bullish case for this new outlook that we have right now, potentially. Because if we go ahead and take the average free cash flow, we'll just take these three here. We'll take 351, minus 297.74 plus 950, divide that by 3, we get 333. So this is actually a lot more conservative. So we're taking the last 3 here. The thing is, you have to ask yourself, was Oscar trading? Let's do the max here. So we can add 207.6. We can tell how much you want to add and then divide by 4. So 198. So yeah, we're actually overshooting here by 2-3 million, which is fine. It's not going to change much. You could go ahead and make it 300 million. And then you could see this going back and forth. But again, too risky. 6.22. I would say as of right now, they need to prove themselves. They're unprofitable. They're going to be. So this is kind of where they're, what range from the intrinsic value perspective they're going to trade. Now, obviously, this is why, you have to ask yourself, we go back to the shorts and we go to the shorts for Oscar. And then we go to short interest. You can see why Oscar short interest is 35.73%. Wall Street is doing this calculation and they're saying, wait a minute, if they trip up on average free cash flow and they're actually free cash flow negative, because if they become net income, because the problem is you can't assume net income negative, free cash flow negative, because if you go here, they were net income negative, but free cash flow positive, right? So it's again, it's tough. It's tough to say. But potentially if they become free cash flow negative, and let's say that they're low, then that means we would have to, go back to the drawing board 9,177.94, and then take this and then multiply it by 0.05 and estimate free cash flow But then even then, it'll be a lot lower than the estimation now because they're not doing it. So Wall Street's probably thinking this thing can go lower, right? It's probably thinking it can go to the $8 to $10 region, potentially based off of what they're doing here. But this is where things get interesting. So, lots of folks are asking me, hey guy, why aren't you doing covered calls for Clover, on this example $1 million portfolio that I have? Now we could go ahead, right? I'll just give you an example. Let's go ahead and trade options. If we go ahead and trade options, this is 1 week from now. Sell a call. If we want to sell a call next week, we're going to make. I have to do the math here. 336,000. We have 360,000 shares divided by 100. That's 3360. So we put 3360. We can make next week 16K. So about 16,500, right around this.
60,656.00.
So on average, right now, if we do this for the next 4 weeks, we can make around 66K. We could just be able to buy more shares or whatnot. Obviously, in 2 weeks, we can go ahead and make 60K in 2 weeks. Either selling a call. Obviously, we can sell a put. Obviously, if it gets called for, we just reverse it. It's called the wheel strategy. This is exactly, what we're going to go ahead and be doing and teaching. But I'm going to explain to you, we're about to do Oscar right now. But I'm just kind of giving you kind of the example here of why I'm not doing it. Let's go ahead and do like around 30 days out. There it is, 87,000. Let's do this one here. This one, again, this is 67,000, right? But now let's go ahead. And there's a reason why. So when the stock price when the stock price hits the strike price, stock and strike, it's like two different. Like it almost sounds the same if you say it too fast. So let's do the example here. Right now Clover's at 307. Okay. And let's say a month from now, I'm saying I want to do a covered call at $3.50. I'm making 20 cents. So I'm making essentially $67,000. The problem is once it hits 350, I would have to sell my shares at 350. It caps your loss, right? We're going to be talking about this in the future, kind of about the graph, kind of how to interpret these graphs. And essentially, we're going to be talking about all the Greeks and whatnot, and go really in depth and, do calculations, etc., intrinsic, extrinsic value, all this important stuff. But, and we're going to call professionals on that have, over $15 million portfolios. We're going to call professionals on, and they're going to go in and we're going to go ahead and collaborate to really try to maximize learning, right? Because it's all about learning, right? Trying to get you out of the matrix. So we're going to call on professionals to come educate. And also, I'm going to be calling some really world-renowned professors that are millionaires that do this as well. So there's a lot of really good things that are about to happen. And I'm going to pay them, for the professors, and we're going to definitely help them out, and maybe give them a speaking fee or whatnot. But it's all going to be covered in lifetime access, right? That's the beautiful part about all these things, right? The whole point is you guys don't understand the value that you're getting here. You guys you have no idea what you're getting. All right, so so based off of this, if it gets to 350, you're gonna have to sell your shares. So let me do another example, since we could do a cash secured put for this example. So let's say next month. So right now the stock price is 307. Okay. Let's say I think the stock price is actually going to go to 3. Okay. I think this is stupid. There's no reason why you should do a cover call here. But it makes sense to do it in the short term. Long term is stupid. It's paying the same. So, okay. Right now the stock price is $3.07. Okay. Hosaifa, I'm going to answer your question right now. So stock price is 307. On August 8th, or let's see the 6th. Let's see. Yeah, let's do 2 weeks out, 13 days. On August 8th, let's say I want to do this one. I think the stock price on August 8th is going to be lower. I don't think so, but let's say it's going to be lower. I'm willing to sell them. Let's say I think it's going to go back down to $2.50, right? If I do a covered call at $3, I'm saying that I'm okay selling my shares at $3 or above, but I'm getting this premium. So in about 2 weeks from now, I'm okay making $100,000 because of this transaction. But here's the problem. What happens if the stock price, let's say, goes to 250? That's actually good for me, right? Because then I still make the 107,000 and I still get to keep my shares. What happens if the stock goes to $3? Okay, that's fine. I still make 107,000, but I have to give out my shares. But I can buy them back quickly. What happens, let's say, if the stock goes to $7? Well, that's the problem. I have to sell at $3. That's the issue. That's why I'm not doing covered calls right now, because it is so undervalued. And I think this thing is about to pop. Okay. Now, let's say, for example, if we do the intrinsic value, we ran the numbers, and let's say the value is at $3. It's not, but let's just, for the purposes of education, because we have to play scenarios. It's like taking practice quizzes and tests, right? Let's play this scenario out. So let's say, for example, the intrinsic value is $3, and it hovers anywhere between, $3 to like $3.50, right? So let's say, for example, I do that, and let's say, it's at $3, and my shares are gone. Okay, that's fine. I would have to sell. I have $1 million in cash now. So what do? Now I just do sell a put. So now I do a cash secured put. So now let's say, the stock price is above 3. Let's say it's at $3.05. Or hey, we have it here. It's $3.07. And let's say now I have all this cash. They took all my shares. Now I have about $1 million, right? Because again, I'm selling my shares. Now what do? Now I say, you know what? I'm going to go ahead. I'm going to do a cash secured put at $3. And what that basically does is I make $83,000, right? Almost $84,000 in 2 weeks, right? And I can do this every week. It probably pays better, right? It probably pays, 13, I'm sure it pays, but let's just do this for right now. It pays an extra cents. Who cares? So now so what does a cash secured put do, right? So it's cash, right? You give them cash, so you're securing a put. So what happens if the stock goes to $4? That's fine. I don't buy my shares at $3, but I still make the $83,000. Let's say it goes to, $3. Okay, that's fine. The deal's a deal, right? I buy my shares back at $3, but I still get to keep the $83,000. So you see how I'm still making money? It's the wheel strategy. I'm always making money. But here's the problem. What happens if it goes to $2? Well, that's the problem. Now I have to buy it. I still have to buy it at $3. It'll show $1 loss. But guess what? I still get to keep the $83,000. But you see how you see the most important thing here? When you do a covered call, you need to understand how much the stock is worth. Because if it's worth $10, but it's at $3, you don't want to do a covered call at $3, because you've done your due diligence. And if you do a cash secured put at $3, but the problem is it's worth $2, then you're buying at $3. That's not good. So what's the key concept of this whole scenario? The key concept, ladies and gentlemen, is very simple. You need to understand the intrinsic value of the stock. You need to understand how much the stock is worth. How do you do that? You need to understand and have the data. You need to understand and project the stock market by going 10 years into the future and discounting back at what the stock should be trading at today. A lot of people say, oh, it's going to be this in 10 years. No, that's bullshit. You don't understand intrinsic value. Go read the course content. Go educate yourself. Go civilize your frontal lobe. Go depolarize it and make the LTP connection from your CA3 to CA1 neurons, and go strengthen your hippocampus and go learn. Go strengthen those neural connections, right? Go back to the drawing board, right? Go learn, right? This is the stock price at today's value, okay? So based off of this, you can see how it's important to understand intrinsic value. So now that we talked about Oscar and we talked about kind of its intrinsic value, and you can see now there's going to be a $15 to $20 cap in the next at least year, right? Based off of this projection, you could see that short interest is 35%. You can ultimately assume that anytime the stock prices will be going to 15, 16, 17, 18, 19, 20, 21, $22, you're going to have dumbass Twitter X people, idiot people out there that are going to be like, I know what I'm talking about, to the moon. And they're going to act like they're like experts, right? And they have a lot of followers, so you can confuse them, right? As like experts, right? But they don't understand what the hell they're talking about, right? There's no data. I'm sure for the folks that are, first tuning in regarding Oscar, this is the first time they've probably seen something like this, right? It's okay. I get it. This is what the professionals use, okay? So now that we know that there's some type of fundamental cap and short interest cap at the $18, $15, $18, $19, $20 region, Now what you can do, let me teach. We go ahead and trade options. So now let's go 6 days out. Look at these options. People still think the stock is going to go to $35 next week. People literally are so stupid. Wait, let me sell the call. Actually, no, they're not. Okay, they're not that stupid. I'm like, is this retarded? But watch, look how stupid these people are. So now it's very clear from a week perspective. You can see now, no one thinks 18, 19. But guess what? People are still thinking $18, $17, $17, $16. They're still thinking this, which is fine. So now let's go ahead and let's do $19.50. So based off of what we have regarding our shares, we did the math. Let's do the same shares. 300. So now let's say when Clover does go to $14 and we're in this scenario, let's say, okay, right now, if I want to go out of the money, I can do $19. And this is very conservative, right? Like, I don't think it's going to go to $19. And if it does, it's going to come back down based off of what they said in regards of them basically going from a previous guidance of positive 250 million of operating income to projecting negative 250 operating loss, which is a $500 million shift. Okay. What a joke, right? So now knowing this, you could see you can make $16,000, which is like you could sleep at night not knowing, your shares are you can make 64K right now. Or you could say, you know what, man, I think that this is going to be a lot lower. It can go a lot lower. I think, $14, $15, $16. I think personally it's going to be bouncing around that region. So I'm okay going nearer at the money. And there's going to be a lot of gamblers. And I'm okay with that. And I want to squeeze these gamblers. So you could go in and do this. And now you can make $134,000 a week. Literally $134,000 a week you can make. Right? And if this trades at 15, if this trades anywhere between, let's say, $10 to $18 in the next 12 months, you can make $134,000 a week. Right? So ultimately, what is that going to do? Right? So you're making $134,000 a week multiplied by 4. That's $536,000. In a year, you make $6.4 million. On a portfolio normally like this, if we have these many contracts, you would have essentially at the current price, that's about a $4.8 million portfolio. You're making $6.4 million. So you're essentially doubling your money. The question you have to ask yourself is why? Why is it like this? Because these people, especially on Twitter, they've talked about how bullish they are in Oscar, that people are actually buying calls. They're buying calls. And ultimately, it's again, you're essentially taking money from these idiots. Okay. Now let's go ahead and go 2 weeks out. We go from 40 cents to $1.15. So now this actually pays even more. So now this is paying $1.15. So now this is paying $386,000 every 2 weeks. So you do that, multiply that by 2 because it's every 2 weeks. Now you're making $772,000. So now what you're basically doing is what you're doing is you're taking money from someone who's gambling, who's buying calls because they can't afford shares. They buy calls, right? And what they're doing is these people that buy calls, they don't have access to this data. They don't have access to the numbers. They don't even know they don't even know what the numbers mean. And to be quite honest with you guys, they don't even know what Oscar even does. They don't even know what the company even does. They're idiots. And I've seen people say that on Twitter. Like, I don't know what this company does. I'm just going to buy it. I'm going to throw a little bit of that and buy some calls. What ends up happening is you have a bunch of dumbasses, a bunch of NPCs buy a bunch of calls. These dumbasses have, like, let's say you get 100,000 dumbasses buy a bunch of calls. That's going to fuel the options chain. So you could go ahead and do a covered call at these prices and literally take their money every 2 weeks. Let them donate the money to you. They don't need it. They're idiots, right? Let them enjoy the casino while you are data driven. And what's going to happen is you're going to essentially, in the next 12 months, most likely get your shares for free. You're going to get your investment for free, right? Or you could double down and buy more shares, which is exactly how Master DeChin was able to go from 74,000 to over, to $1 million. He was able to double his shares by using this strategy. Huh? You see that? Or you want to say, you know what, man, I don't want to do weekly, 2 weekly. I want to enjoy my 5 minutes of peace on the toilet. Okay, that's fine. You could get paid. You decide when you want to get paid. You're the boss. You've broken out of the matrix, homeboy. Okay, you could do this one. That's fine. I don't recommend. I recommend the other one because you'll be able to make more money, right? Doing a week or two, right? But that's the power of the platform, guys. This is the power of being able to take this options chain and being able to, look at these speculators and, have them gamble while you just take their money, right? Because that the stock price he's projecting 2027, it's going to be up there. So you might have about a year to play this game, right? And then the stock, and you're going to get runs, of course, like anything, you're going to get runs. You're going to get these little runs. Let me show you how they look like so you can see, you're going to get these mini runs, $22 back down to $13, $18 back down to $13, $17 back down to $13, right? $16 back down to $11, $17 back down to, $13, $21 back down to $13. I mean, what does that sound like to you, right? What does that sound like to you, right? $18, $21 back down to $13 and $13, $21 back down to around $11, right? Remember there's $11 down here, right? And you could essentially ride this wave, but again, you have to do more. You have to go back and you have to go use this and you have to look at the algo flow. You say, okay, what is the algo flow state? Let's look at the algo flow for Oscar for the past, 5 days. You look at the algo flow, you do the analysis, you see where the options chain is going. Oh, okay, the algo flow is going down, so I'm expecting the stock to actually go down. And if you let's see if it actually did that. You can see right now in the past 5 days, it's been doing good. Obviously, it's been going down, but now potentially we might actually, go up to 14, 15, and then it goes back down to 13. But you can see how this is data driven. There's no emotions here. It's all data. That's all it is. Okay, that's fine. Let's say you do 15, it sells you out at $15. Okay, that's fine. That's fine. Watch. If you do 15, okay, let's say it goes to $18. That's fine. Do a cash secured put at 15. So when it drops back down to 14, 15, you bought at 15 and then do a covered call at 15. It's a money game cycle. But the problem is you need to have the data. You need to understand how the data works. And then you can basically milk these idiots. There's a lot of idiots out there. Why do you think the short interest is this high? There's a lot of people out there that don't know what they're talking about, that are just on Twitter pushing Oscar, that are not data driven. How many people talk about Palantir now? But back when it was $6, no one was banging the table. Now everyone's banging the table, right? So you have all these folks now talk about Oscar. Oh, there it is. People are starting to realize, holy effing crap. You know what I mean? Like Oscar's SI is nearing 40%. They're starting to see it. Right? But the problem is they don't know how to connect it. They don't know that. You think they know what intrinsic value is? They don't know this stuff because the Wall Street doesn't want you to know this stuff. You need to have access to institutions. Are institutions buying? Are institutions selling? You have to look at analyst estimates. You have to look at all these things, right? This is why when I'm telling you this is going to end up being a $20,000 software package, you're going to end up being priced out of it. And it is what it is because you're going to have access to people that have over $1 billion net worth, right? That's what happens. Wall Street doesn't change. The Constitution hasn't changed, and it's been 250 freaking years. Well, you think Wall Street's going to change overnight? These numbers don't change. That's why they're called fundamentals, right? Not the PE crap. We're talking about real stuff. We're talking about free cash flow, intrinsic value. We're not talking about stupid PE. Okay? People that talk about PE don't know what they're talking about. That's the cheap way of doing things. We don't like cheap, right? We like quality. So I want to see if I can find that post. Don't know what they're talking about. Let's see. I'm going to ask Grok. Let's see. Hey, man. So a while back, I saw a post regarding Oscar Health, ticker symbol. Someone was saying that a lot of people are talking about it, not knowing what the company does. Can you help me find that tweet? Let's see if it can find it. Because it's just funny. And then the guy admits himself. Let's do a quick answer. Can we quick searching? Damn, I shouldn't have done quick answer. It was actually doing really well. Anywho, whatever. Honestly, actually, you know what? I think I know one of them. Let's look at one of them. Actually, I think I know one of them, guys. Yeah, this guy. Okay, watch. This guy has been posting the same thing for a long time. Okay. If you look at his old things, he was thinking. Now again, he's only reflecting. He's just posted this right now because of the what the CEO is saying. So let me just go ahead and go to media. You're gonna have a lot of people do the same thing. So now let's go back down to what he was saying. Oscar was. He posts so much. Let's see if he talked about Oscar back then. Let's go back a little bit more. Do you guys see Oscar anywhere here? Here's Tesla. You could see kind of, let's see if we can open up Tesla. Let's analyze Tesla real quick. So he was saying Tesla was like this, and he's expecting it to go to 500. Obviously, you look at, he was expecting March 2025, it'll be 500, right? And then now look at it. Why? Because he doesn't understand fundamentals. The stock didn't go. It went down to 400, down here, right? Because he doesn't get fundamentals. Okay, so now let's see if we can find Oscar. He didn't start talking about Oscar until they started pumping it earlier this year, so that's fine. We'll find. We will find right now here, a little bit here. We'll just scroll up until we can find Oscar. Let's see if we can see it here. We'll see his first picture. There, I think this might be the first one. This was May. Okay, there it is. Okay, so you could see that it was already, this was a couple months ago. So this is, I don't know if he removed the other ones. He just started talking about it. Okay, I'm officially calling it. So this is his first one. Okay, so it was going down and he's expecting it to essentially go up to 30. So what ends up happening is people are basically saying big rally ahead for sure. We're in the buy zone. A lot of these people are buying most likely calls. In fact, let me see if I can. There it is. Any call? Anyone says call? Who's there's just saying who's calling it. So you could see ultimately, he's projecting that the stock is going to end up going to 32, and then, honestly, this honestly, actually, I agree with this. Actually, I agree with this. This is a, let me think here. I think we're not going to go to 30 in 2026 this year. He's thinking, okay, guys, listen, okay. He thinks this is where I don't agree with him. Long-term 2027, I agree. It's going to be around 50 to 60 around this price if they are able to execute. Okay. I don't agree with this. And this is where you can make your money. This I'm okay with. I have no problem with this. This is where I have a problem. And we're going to go ahead and from first principles, we're going to zoom in on this. In fact, let me just take a better screenshot. We're going to zoom in on this. Let me take a better screenshot. We're going to zoom in right on this. There it is. This is where my problem is. And we're just going to take this here so we can see the price. So this is where my problem is. So here's 2025. Here's the beginning of 2025. He was saying it's going to go down. Okay. Then here's July. He's expecting the second half of 2025. This is still 2025. This is the starting of 2026. This is January 2026, right? And this is the halfway point, 2027. He thinks that from now and then 2026, he thinks the stock price is going to go from $14 to like $36. He thinks it's going to go from, he thinks that in the next 6 months, the stock price is going to go up 100%. That's what he's saying in the next 6 months. So what does this mean? What does this do? It makes the options chain gamble worthy, and it causes the options chain to be able to pay you money. So you see this, how this short term is what people are seeing. They think this is going to happen, and they're dumb money. So they're just going to toss these calls, and you're just going to get them. Why? Because you've done the fundamental analysis. You're like, well, if this is what it's going to be, we just got to look at the free cash flow. We have to analyze. We have to see, right? So if it ends up oscillating between kind of plus or minus here, it can oscillate between here. Then you're able to do cover calls, catch accurate puts, but to just go out in a straight line, no, right? So you can see how he's thinking by the end, not even the end. He thinks by, what is this? Let's say July, August, September, October, November. He thinks by October, this thing is going to be $30. He thinks it's going to be $36. He thinks that Oscar's going to be $36 in the next 3 months, right? That's what this is saying. Okay. So then that's his analysis here. So now let's look at his most recent. I'm curious. Again, analyze everything, guys, right? Again, you guys got to be smart. All right, so let's go here and let's look at the most recent one. Here's the most recent one. Okay. So here's this, here's this, here's this. So he's still saying the same thing. He's still thinking, he hasn't changed it. He's just repeating. He's just pushing. You see right here, $32 incoming. Mark my word. He still thinks that $32 is coming in the next 2-3 months. So I'm curious to see, are people buying calls here? I assume that's what they're going to end up doing, right? So this is where I have a problem with, right? This huge jump is hard when fundamentally doesn't make sense, when you have shorts increasing, right? So again, very difficult, okay? So, but again, you know the intrinsic value, then you're ultimately able to squeeze the options chain and make a shit ton of money on options and be able to make $200,000 to $500,000 a month off of this and be able to make your shares back for free. It's amazing. Let them donate the money to you. Let them, because they don't have access to the data. So again, so we talked about that. For folks that are interested, again, guys, this is the real deal. It's all data. There's no bullshit, right? I went ahead and I said, you know what? I agree with the latter half, but the short half I don't agree with. Right? We give credit when credit's due. There's no football team analogy groupthink here. It's either we believe you're right or wrong, and here's the data why. And I could be wrong, but at least here's my data. This is why. Right? The market can remain irrational more than you can remain insolvent. So it's fine. Right? But ultimately, we're data driven. And the longer we do that, we're investing in businesses. We're not investing in stocks. We're investing in businesses. Okay. So ultimately, this is what's going to end up happening for Clover in the future. Okay. We're going to calculate the value of Clover. Okay, watch, hold on. So you know how I said we're going to go ahead and do the value of Oscar? And I said long range, though, if you look at value, look at here. And then you go here and you type in 6.22%. And we said the base was 48. You see how we go back here and you see the base. The base was $48. You see how powerful that is? Do you see that, right? Pretty impressive, don't you think? The base is 48, right where the CEO was saying it. Now let's go ahead and do Clover. So for Clover, right now, we'll go ahead and do here. We'll do 2 different calculations for Clover. Here's Clover. Free cash flow, we'll use this one. Obviously, this is a fake one because they paid $47 million one-time payment. It's called discontinued cash flow. What does it mean by fake? Let me explain. This is an educational platform. Clover Health Investor Relations quarterly earnings. That's fine. We can show you. Quarterly earnings. We go to this one here. We go to this one. And we go to the cash flow statement. We go all the way here. We go highlight this This is cash flow from continued operations. Here's cash flow from discontinued operations, meaning that this 47 million is not going to come back. Actually, cash flow is 83 million, right? That's why we put 34 minus the property, plants, and equipment. It'll get you to 33.29, because you take the 1.56, you add that, you end up basically getting the 34.84 million. Okay. So what ends up, but here's the thing. The other calculation is we're going to remove unpaid claims. So this we're going to add into it. We're going to have 82.4 million. We're going to remove unpaid claims. So we're going to take 82.4 million minus 19.2 million. But then we're going to add 43 million, because remember, this is subtracting, parentheses means subtracting. This is net loss. I think Clover might actually be break even this year, if not profitable. We'll have them at break even. Okay. And then we'll run the calculation. Okay. But first, we'll run it as is from this number here, right? We'll do this.
33.29.
So if we do 32.29, and if we do basically what they're growing at, 9.33%, actually, wait, 9.33 plus 33%, what are they? Yeah, they grew around 33%, divided by 2. Average right now, they're growing around 21%.
21.165.
You go ahead and do that, and you get a price target. Here's this. You get a price target of 91 cents, recession, bear case 175, base case 234, and best case 335. What is it trading at now? It's trading between the base and best case. Okay. The problem is next quarter, they're going to be profitable. So then the growth rate now is going to be higher, because then you're going to add 9.33% plus the 33%. And who knows, they might even grow 37% next quarter. Right. So if you want to make your life simple, you could just say 37% growth for this using the cheaper one, which is 33 million, which actually is not correct, because that's assuming discontinued cash flows from operations will continue into effect, which is not correct. But if we do that, we could see a stock price of recession of $2.27 and the best case of $10.14 based off 37% growth rate. Right. So we're assuming this growth rate is going to be continuous. We could be conservative. We could say 25% here, and then we could get anywhere between $1 to $4. Right. But we'll say 37%, since they're returning the growth phase, we could see $2 to $10. Okay. Now watch this. This is where I think this is going to be funny. That's 33.29%, right? That's the lower end. And that's where we're at right now, 37%. Okay. If we want, we could take, 30%, or just we could take the, let's say we could take 27% plus 37%. I think they're going to grow more than 37%, but that's fine. We could do this. We get 28.5%. So we take the halfway point, and then we could get this. So we could say, you know what? $1 to $5. But again, we're using the old free cash flow. So now let's go ahead and use the free cash flow that we talked about. So we take the 82.45 million. We're going to subtract unpaid claims, which is 9.2.6 million, which is this unpaid claims. We're going to subtract unpaid claims, because they said they're going to be paying claims out faster, so they can potentially get to those 4.5 stars. Who knows? Then we're going to add back 43 million, because we think they're going to be break even. So we're going to do like 43 million. And if they get profitable, we can add even more money on top of that. So that'll give you 106 million of free cash flow. So we do this 106 million now. And by the end of the year, we can get anywhere between $4 to $17, right? Again, I'm saying by the end of the year, but I would say 2 to 3 years. It takes time for this to play out, right? So don't be like, oh, you said this, you said that. Use your brain. Assume it'll take 2 to 3, 4 years. Okay. You don't like that? Go gamble in the casino, or go start something to, maybe only fans. I don't know. Right. Do something like that. Right. But investing takes time. But this is where the magic is. Okay. $106.154 million free cash flow. That's at break even, which is impressive. Growth rate now, if we put in 37% growth rate, look at this. $7 recession to $32. Now you understand why I'm not doing covered calls right now. Why? Because it's undervalued. Because Clover just dropped $18.2 million in share buybacks at $3. Here, watch. Let me show you. They dropped another. Watch. We go here. We go here. We go to the cash flow statement. There it is. There's the cash flow. Watch this. Let me zoom out. Watch this. Repurchase common stock. They put in $18 million. You go to their quarterly report from their SEC filings. They bought it at $3.60. Right? You know what's funny? They also use cash to also buy their treasury stock. So they actually bought their treasury stock back. This company just put in $31 million of treasury. They keep buying their own stock. Why would they do that? Don't be stupid. Why would they do that? Right? Because it's undervalued. So that's why I'm not doing covered calls. But guess what? Let's say, for example, it starts going to 35, 40 bucks. Okay, that's fine. We'll activate it. Because if it's worth less than that, then all right, my friend, go ahead and gamble, retail investors. I will take your money, right? And this is what's going to happen. You're going to start seeing that I'm not going to be giving out this data anymore. Because then now, because remember, I just started a new company, okay? Right? I just started a new company. And I need to put about $50 million in the next 15 years. You know what I mean? So I started a new real estate venture. We're going to be investing $50 million in the next 15 years in Arizona. Okay. So I can't give this information out anymore, right? The only way to get it is you got to get access to the lifetime access. And by the time these prices get reached, lifetime access will be $20,000. So are you seeing how, sadly, we're creating a division now? We're able to help. We showed people out. We showed the world what's going on. Likewise, this data is expensive. I'm losing money right now doing this, right? This data is expensive, right? You could see this. I'm self-supporting this, right? Lifetime access members have a fund, and we're using this fund, but you can ultimately see this is, in the long run, this is expensive for me. But the whole point is to be this. Think of it, to me, this is like a nonprofit in a way, right? Because I'm able to basically showcase this to you, to show you guys that this is what Wall Street's using. I just got tired of someone who's going to be a medical doctor. I just got tired of the rich getting richer, and I got these patients coming to me, and they are where they are, and I can't really help them because it's too late. So at the end of the day, unfortunately, because of the prices and the fact that this data is going to be influential based off of what we're doing with the covered calls. And the unfortunate part is, and you can see from our research, when we post good research, and when we have a lot of people hyping the stock, unfortunately, there's going to be a lot of views. Like, for example, we went ahead and posted this, and this got over 114,000 views. The unfortunate part is, if we post this information and people know exactly what it's worth, and people obviously are going to see the portfolio and what we have, they're going to be following this. And we don't want those folks to do that. Only the people that add to the lifetime access mission, right? And ultimately, that's going to ruin our edge that we have to be able to milk these calls, which will ultimately, I'll lose my edge in investing in my real estate firm, right? So you could see ultimately how this is all conglomerating and working, right? So at the end of the day, I don't know what you're waiting for folks that are out there. The door will be closing. It'll be a very hard door to get into. But for all the people that argue and saying, what about retail investors? It's okay. Opportunities come and go. But you know what? You know what's there? Let me show you. It's okay. Because if you go here and if you go to the YouTube channel, we have over 875 videos. We have over 875 videos that show you how this is done. So if you're watching this and lifetime access is like 25, 30K, you know what? If you don't have that kind of money, I get that. I'm sorry, but it's okay. By then we'll probably have 1,000 videos. Okay. You have these videos, watch them from the beginning. Okay. You either pay with your time or you pay with your money. Right now, this is pretty cheap. This is unheard of. This is like dirt cheap. But you either pay with your time or your money, okay? And this data is expensive. So ultimately, I recommend watching these videos, learning what this is, and trying your best to get a whole bunch of subscriptions. You're gonna have to, get a whole bunch of subscriptions from other people, and learn how this is done, and try to basically glue it all together, okay? And this is your path. The answer lies in these videos. Spread across all the space and time. Okay. For the folks that are watching now, you have the advantage to be able to join us for life and be able to break out of the matrix. Okay. So it depends, Grumpy Cat, regarding the margin of safety. You have to look at the Greeks. You got to look at the technical analysis. You got to look at about intrinsic value. you're in our lifetime access platform, so you'll be able to see that, and we'll be able to dissect it together. And we're gonna have all of our we have different. Everyone has strengths. We have people that are good in technicals. We have we're all gonna come together, and we're all gonna basically have our own. The vision is we're gonna be on the Zoom call together. We're gonna have about 100, 3, 4, 5, 600 people join. And we're going to have different divisions, and people are going to talk in different divisions. Each division is going to have 20 to 50 people in it. All right. For the people that have the healthcare division, what does your leader of this technical analysis say? And only three people are going to be talking from every section. Okay. Right. These are the people that people are elect, and they can elect them every year. It's going to be a democratic process. And you're going to have about, let's say 600,000, 2,000, 5,000 people. And each people are going to be split in different sectors. Okay. And ultimately, those folks elect their options guy, their covered call guy, their intrinsic value guy, and their technical analysis gal. Who knows, right? And then you go in, and then from this perspective, they get out the analysis for each section, and then they see asymmetrical opportunities, and the people that listen, they can do their own calculation, and they can see if they're following it. And if they don't follow it, they can ask the question. They can say, actually, I have a question. How are you getting this number? And then that leader would have to go in and show. Right? That's kind of where we're going. Okay. And the beautiful part about this is I'm going to end up basically doing this. And a lot of my lifetime access members, I'm going to end up basically doing this either at a couple places. Either it's going to be, what have you. Let me see here. Where the hell did it go? One moment. Oh, that's interesting. One moment, please. This is kind of like what I'm kind of envisioning here. If I can find it. There it is. I'm going to be doing this. Let me show you guys. Man. Okay, that's fine. Let's see. Let me share you the screen. I'm either going to be at my father's-in-law golf course. Right, my father-in-law bought this beautiful golf course, Troon course, and I'm going to use the data here. Right, run the analysis, run the numbers, run the software, have my cold brew coffee. Actually, no, this was a Diet Coke, and then have this beautiful view. Right, and have the golf course to myself, of course. Right, close it down and have a good time. And obviously, after hours for sure, right? And enjoy, even during hours. I'm either going to be in Miami, beachfront view, relaxing, or Cancun presidential suite. And we're going to go ahead and make money. We're going to make money. We're going to have the life that we deserve, right? This is the lifestyle that we're going to have. It's beautiful, isn't it? Right? You can get access to this, right? How the hell did I do it? Well, you guys know my story. I started from nothing. No mom, no dad, nothing. Just pure grit, pure hard work. You could do it too. And you have the path. You take the red pill or blue pill. You decide. God bless you guys, and I'll see you on the next one. Peace.